Okay. Why don't we all sit down? I was told to sit under your names.
Oh,
Oh, under the names, okay.
and I think I'm here.
I just want to say once
pretty
again,
simple.
I said it, if Todd is still here, I just thought that was absolutely fabulous, and inspirational for all of us, and I think we all learned something, which ultimately, if you leave here today and you've learned something, then the Lord has accomplished a lot. I want to, of course, welcome our distinguished panel. It's quite remarkable when we look at our hemisphere that we were able to assemble three people that will clearly indicate how we are all interconnected. Paula did a good job giving background, but Secretary González, not only was he the Minister of Finance, but he was also the former CEO of Pemex. David Roberto from Goldman was very courageous, as he was one of the first economists to say the United States was not going to have a hard landing. And you'll hear from him soon his prospects for the future of the United States. And in so doing, it's really the prospects for our hemisphere, of which obviously Mexico and Brazil are important parts of that. So given the geopolitical uncertainties, the effects of global inflation, the increasing debt overhang of the United States, we are very fortunate to have people that are thinking, living it, and being part of that, and the consequences of it every day. The world is clearly not in equilibrium. Spending does not equate to output. Debt is still not in line with income. Today, we will hear how global concerns, particularly in developing countries like Brazil and Mexico, are directly influenced by considerations in the United States. Brazil, as we all know, was one of the first countries to raise interest rates, and the governor of the central bank has been given credit for reducing double-digit inflation, and at the same time, keeping the economy growing without excessive FX volatility. Truly a miracle, I would say. It is an expectation by late this year, early next, inflation in Brazil will be within the targeted band, and therefore now Brazil is one of the first countries to start a significant reduction in their double-digit interest rates. Only last week, another 50 basis points. However, we all know that there are a lot of winds blowing in Brazil. Will Brazil continue to attract FDI? Will the current currency lack of volatility be contained? Will employment continue to grow, and will the economy keep expanding? How are the geopolitical issues throughout the world affecting one of the largest economies in the world? And at the same time permitting, of course, Governor Campos, why is Brazil leading the world with financial democratization and digitalization? With that, the governor of the central bank will be our first speaker.
Okay. Stay here, go there. I can stay here, yeah. It's more informal.
I like that.
Well, thanks for the invitation, Cliff. I want to thank everybody for participating. And the idea is to talk a little bit, you correct me otherwise, but the idea is to talk a little bit about macro. And then if we have more time, we can go into the digital agenda of the central bank. Probably starting on the macro, and I'm here, I need to see what David has to say, but I think it's very difficult to talk about Brazil and not talk about the global scenario right now. And I think on the global scenario, one thing that we have been watching for a while, and it was actually in part a theme of the meeting in Marrakesh that we had, was basically, okay, so everybody was very convinced that we were in this process of disinflation. And it seemed sometimes all too obvious. But the question, and we started asking ourselves the question, where is the disinflation going to come from? And you would look at the usual suspects for the global disinflation. And you would hear, okay, eventually labor is going to be more flexible, and you're going to have, this lacking labor. And then you look at real wages everywhere, not only in the US, but also in Australia and Canada, most of the advanced economies, and in some emerging markets too. And you're seeing real wages going higher. So it's not going to come from there. And actually, labor market's tight in most places. Then you would hear, okay, but have very high interest rates. The mortgage market is going to take a big hit. It's going to impact the balance sheet of the families, and they will consume less. And what you see today is basically the falling of real estate has stalled, and it's going back up again in Canada and US and Australia and most places. You look at some of the instruments that are tradable and can anticipate a little bit the pricing, and you can see they're going higher, or at least they're not going lower. So it's hard to imagine that disinflation would come from there too. Then you would hear a lot this argument that you have this excess savings that was produced during the pandemic, and then the savings would go down, and eventually that would be a restraint. And you look at this excess savings story, and it's very difficult to calculate, especially for the US. And mostly what you see is that you still have excess savings higher than you had pre-pandemic. So even if it's not a big constraint, it's not a disinflation factor in itself. Then people talk a lot about the way, at least in the US, that people have accumulated savings at a higher, at older age, and now they're spending more because you're moving the age of the population. And there are many studies that see that. We look at the consumption, try to break it down by age, and you can see that. And you can see some other places too. And then you look at the cost factors, and you try to move from, when you shift from demand to supply, and you look at the chains, and you talk to companies, and you look at indexes, and everything is becoming a little bit more expensive because the green transition is more expensive for companies. The nearshoring and friendshoring has been more expensive for companies, and we have actually spent some time looking at that. So on the cost side, doesn't seem to have a lot of disinflation either. And then you have the oil prices, which with all the conflicts that we have, very difficult to imagine that it's going to go much lower. So the question that remains is, where is the disinflation going to come from? And that's, I think, one of the things that we spend a lot of time talking when we meet with other central bankers. And I was very, very skeptical 6-7 months ago when the argument was so clear, because I didn't see where those were coming from. Obviously, you're seeing some soft data. You look at credit and you see something in credit and SMEs and things like that. So that's the first argument, is it's not so obvious where the disinflation is going to come from globally. So it might come down a little bit, it might be slow. And then the second part of the question is, if that is true, it means that interest rates are going to be higher for longer. Might not be as high, but at least the process of lowering interest rate could be slower. And then you look at what happened in the post-pandemic, and the reality is advanced economies spent on average 20% of GDP. Emerging market economies spend 10% of GDP. And low-income countries spend around 4% of GDP facing the pandemic. So the ones that spent the most were the advanced economies. And pretty much most of the debt went from between 60 and 70, and an average now is 106 when you look at advanced economies, depending on how you select the
percentage of GDP.
Yeah, right. 106% of GDP, but the rate is much higher. So when you look at the cost of rolling over the debt for advanced economies, and you try to do a simple analysis of use and proceeds of funds, you have to think that at some point in time, there's going to be a liquidity squeeze, because the amount of money that is needed to roll over the debts is very high compared to what we had in the past. And then we try to see what in liquidity squeeze process, what you see. Basically, you started to see the emergency lines going higher, the debt for emergency lines going higher, and we learned that in emerging markets. So credit card debt, SMEs, now in the US SMEs, the marginal rollover cost is around 10%. And so we looked at all these indexes, and the question is, what is the effect of that in emerging market countries? And the way the debt is structured, when I look at the profile of the debt and the amount that is needed to roll over every month, it accelerates a lot next year. And if rates are going to be higher for longer, every 6 months that you need to roll over this debt at close to 4.5%, is an additional liquidity squeeze, and we think that is sometimes miscalculated. So that's one point. And for that, and then now going back to what that means for emerging market countries, it means that we need to do our homework better, because liquidity is not going to be so available as it was in the past. And so I now get into the story of Brazil. We always believed in Brazil that, and we had a history of inflation, so it was kind of easy to see sometimes the movement that was building up from the very beginning. So we thought if we do the interest rate job faster and sooner, it costs less, because time is everything in monetary policy. So we started to see some of the pressures building up. There was this global analysis that it was more a supply phenomenon than a demand phenomenon. We never agreed to that. And we thought, okay, I'm seeing so much money being put to work. The fiscal was so high that at some point in time, you're going to have this build up pressure in inflation. And we saw it globally too, and we started to hike rates. We were more aggressive. It's also true that the rates in Brazil were lower, so it was easier to do that because we're very far from neutral at that point in time. And again, I think a lot of we talked a lot about that when we have meetings in the central banks. We prepared ourselves for depression, and we got a mild recession, depending from country to country how you see it. But then you started the hiking process. I remember sometimes being called the elephant on the crystal shop because we were hiking rates a lot, and people were not doing that and not seeing it. It's also true that Brazil had lower rates, so it was easy because we were very far from neutral. And then what we started to see was actually that, and it was common to a lot of other countries. So even though rates were very high, the economy kept surprising on the upside. So we've had 5 years, consecutive 5 years, that economists misestimate the growth. So that was true in 2019, 20, 21, 22, and 23. And so at some point in time, you look at what the economists call the potential growth, and they kept going lower, even though you are, kept revising growth on the upside. And to calculate potential growth is a very difficult exercise for an advanced economy. For emerging market economy, it's a much more difficult exercise. And I think we started to realize that perhaps there were some factors, and still today, a lot of people working on that. There are some factors that are actually making growth a little bit higher, the structural growth. And I started to look at micro things, so like velocity to open and close a company, the ability to hire and fire, and the cost of the turnover. So small things, and they all seem to be improving a lot. But still, when I talk to the mainstream economists, they would say, no, structural growth is very low in Brazil. So I think we've been surprised by that. It's also true that agriculture was responsible in part for a lot of the growth. But the country is growing at 3%, but now it's slowing down a little bit for next year. I think most people expect a slowdown. We are cutting interest rates. We have a credit process that it's similar to some other place. So in some of the emergency credit products, you have a little bit of a build-up on bad credit, but to some extent we see also that the credit started to flow again, and the capital markets start to reopen. In Brazil, they were never closed, but we had a drawdown in issues for fixed income. Equity in Brazil has been a hard market, and it's also it's due to many factors, but one of which is high interest rates, obviously. But I think people tend to value actually looking a little bit at the compound, not only at the discount rate, but also on the numerator in terms of how the results are going to grow. And there is still a lot of uncertainties regarding the future growth in Brazil, and we have many different things happening. Then I would focus on the reforms. Brazil has done a lot of reforms. We have done a social security reform. There was a bunch of micro reforms that were called law of economic liberty that improved the business, the doing business space. There was tax reform, labor reform. There was a reform on basic sanitation. So there are many reforms, and I think all of these reforms collectively are starting to show some results.
May I interrupt you for a second? Because I think I was just looking at two questions I was going to ask, and I think it's a perfect time to insert them, and then we can go back to finishing where we are today. And then, of course, you have to touch upon the digitalization and democratization of finance in your country, which you're a leader on. But I had two separate questions, and I've known you long enough, and I've heard you talk about market expectations and government intentions. And sometimes the role of a central banker is not only about quantitative information like you're referring to, but some of it's qualitative. And if the market expectations are one thing and government changes its intentions, that disharmony creates problems. And you have a debate right now in your country about the zero fiscal budget. And I just looked at Valor today, and 2/3 of the articles in the English edition are about what Lula's going to do, what Haddad's going to do, what the chief of staff's going to do. How does that play out on your role, and what concerns do you have, and how important is it for Brazil? And if you don't want to make news here, that's okay. But how important is it for Brazil to have, I don't even want to ask you the question. Just take whatever you want.
Yeah, the objective of a central bank is to say a lot and not say anything, right? but I think I was going to get to the homework part. I think you jump right into the homework part, which is Brazil is a fiscal story. I mean, if you look at the debt, we have higher debt than most emerging market countries. If you look at expenditure in 2023, we're going to grow expenditure in real terms above 8%, which is almost 2.5 times more than the average in emerging market countries. So it's always been a little bit of a fiscal story. And then the question is, we had a ceiling that was very difficult, because what the ceiling did is it tied your expenditures to the expenditures of last year plus inflation. But you had some expenditures that by law had to grow more than inflation. So we used to make this joke that we had the ceiling, but the floor was going higher. So eventually you get squeezed because you couldn't control. And it was pretty clear that at some point in time you need to adapt the system. So the country worked very hard on a fiscal framework. I think Minister Haddad did a good job trying to, what is possible for us to do given that our expenditures are so hard to change. And now there is this talk about changing the target, the fiscal target. And our view has been the fiscal target already has a lot of provisions for when you are not able to meet the target. So to change the target right now would generate a lot of uncertainty, because if you don't have a target, people might interpret that your fiscal framework has been abandoned. And it's going to be much more difficult to actually estimate what the fiscal expenditure is going to be in 25 and 26. And we economists, when we have more uncertainty, we tend to put premiums. So does the market. So the cost of doing that outweighs the benefit in terms of expanding a little bit more by far, in terms of the uncertainty it generates and the cost of the uncertainty into the macroeconomic variables, and one of which is investment, which promotes growth. So for us, for the central bank, what is important is how this fiscal affects the variables that are important in our framework. So is this going to be important for devaluing the effects? Is it going to generate a premium in the long end of interest curve? Can that contaminate the implied inflation and the expected inflation? And so we look at all these things, but there's not a mechanical thing that I said, okay, if you spend more, then means that I need to change the policy. The question is, spending more means what? And what it means for the variables that are important for monetary policy. And that's what we try to focus on. Obviously, in Brazil, we had a history, and we call this the twin de-anchorage, which is when you say that you're going to do a fiscal and the market doesn't believe in the fiscal, most likely they will not also believe on the inflation target. So those things tend to move together. Not always, but most of the time.
Well, so far, so good, because the marketplace is still relatively calm, and hopefully it'll be when you get back. But I'm going to leave the digitalization and financial democratization to later if we can get back to it. Not that it's not critically important for us, where so much of what we do is invest in what you're doing every day, which is opening up markets. But let me, if I might, talk about Secretary González. One of the great things about being a moderator is you get one-on-one time and you can talk to each of the panelists about what's on their mind. And I found it to be a fascinating conversation with the Secretary about, of course, the upcoming elections in Mexico and the prospects of the different outcomes. Will the next president, for instance, have room to maneuver? That being said, one thing that you may not touch upon, but I took away from our conversation, was that there is one thing that everybody agrees upon in Mexico. I'm not sure that exists in Brazil, but at least in Mexico, everybody believes in free trade. So that's a good starting point because the United States is on the other side of that. Nearshoring, with its benefits, everyone is saying is clearly happening, but FDI is flat and it's really masking that. And I'm interested in hearing your perspective on that. Most importantly, though, as you've heard earlier today, we've been circling Mexico for years. And we see many similarities in what existed in Brazil 8 and 10 years ago when we started our first fund and what's happening today in Mexico. And we've actually made, Scott, you probably know better than I think 7 investments there over the last 18 months. Many of the reforms that allow us to make that investment, including protecting the rights of the equity investor, was something that was only clarified in many ways in Brazil over the last number of years, which is an important element of venture investing. So I think it's very fortunate to have the Secretary here with us today to talk about Mexico today, the prospects for the future, and why it is a good time to think about investing in Mexico.
Thank you. Thank you, Cliff, and thank you, Scott and Valor, for the invitation to come and speak here today. When I spoke and people ask me what I think about Mexico, I become a bit schizophrenic. I have a hard time differentiating my mind from my heart. But I think also the prospects of what the reality is in the medium term and what I live every day. And I have come to summarize it into two issues, and they're related to what Cliff said about trade. In Mexico, we're questioning everything, economically speaking. But the biggest ironies for me is that trade is not discussed. And I guess it makes sense when you have a country that trades over 80% of its GDP. There's so many people involved with trade, nobody wants to mess with that. But that didn't used to be the case. And, I said the number 80% of GDP and nobody blinked. That's a Hong Kong kind of number. That's a small country kind of number. I haven't looked at the Brazil statistics for a very long time, but they're not 80% of GDP by a long shot, I don't think. So, when I look at it, I have the economist problem of having two hands. So on the one hand, the reality looks fantastic. In many ways, the table is set for Mexico. This disagreement or this issue with China that the United States has plays right into the hands of Mexico. In many ways, we're like a small China. Many people think of Mexico as an oil country, but we're not. Oil is less than 5% of our GDP. It's a more significant part of our fiscal numbers, but we're not an oil economy. I like to think of, if we're going to make a caricature of Mexico, it's like a big car manufacturing plant. But you can think of cars or anything else, basically. We're a big manufacturing country. So on the one hand, if manufacturing has to move away from China, Mexico is a perfect place. We share a 3,000-kilometer border with the United States. All of our roads are north to south. It couldn't be better, and if we manage to move, a small percentage of what gets moved away from China, it would make a huge impact. So there's all of this talk about nearshoring that Cliff talked about, and it's true. And we have lived through the opposite. In the early 2000s, when China entered the WTO, we suffered. We had a very hard time. So now the opportunity is just tremendous. So you say to yourself, well, this is great. Why isn't Mexico growing at 10% a year? Well, that's my other hand. We have all kinds of jokes in Latin America. Ones that I like is that they say it about another country that I won't say which one it is, that in this case, Mexicans destroy what God during the day, what God creates at night. So the table is set, and we've in the last few years we've had very not pro-business policies. So this statistic that Cliff and I talked about, given all of the political realities and the economic uncertainty that's going on in the country, I would have expected FDI to diminish, to dry up. And yet it's been flat for the last 10 years, maybe even 15 years. But then you remember the first part of what I said. Given everything I said, FDI should have taken off, and it hasn't. And the reason it hasn't is because the policies that are being done now are not pushing for this. Now, that takes me to the next part, which is, why is it a good time?
How much of that is energy related?
Well, a lot. I'm going to say a cliche, but you can't have anything without energy, but you can't be a manufacturing country without energy. You need to have gas, you need to have electricity, and we can debate the renewables part. Some people argue that, we're not at the equator, but we're close enough, and we have a big chunks of desert that are perfect for solar energy. So even that should work. And the energy part just stopped, basically. I'll give you a number. When I was in Pemex, when I arrived in Pemex, people would ask me what the new energy reform would bring to Mexico. And, in the first few months, I just kind of randomly picked a number. And I said, well, I don't know, about $30 billion in investment. I was there for 2 years. At the end, we had registered $200 billion just in the oil and gas sector. So if you added electricity, add another 50 or something. And that all of that stopped. And your question is very good, Cliff, because Tesla announced a big investment in Monterrey a few months ago. And now they said, look, we're going to have to look at it again because there's no energy. So that's an issue. But the reason I'm hopeful is because there's little room to maneuver as time goes on. All the cushions, Mexico was very orthodox fiscally for a very long time. If you talk to most people in New York, they still think it's fiscally orthodox, but I disagree. I think, the fiscal room has run out, and we're going to be hit with this reality. And then we're going to be forced into all of these things to take off. So when people ask me, is it a good time to invest in Mexico? And I said, it's a great time to go fishing in Mexico. And wait a couple of months to take out your checkbook.
But let's look at the other side, half full. We speculated why Mexico is doing as well as it is. And a lot of it has to do with what David will talk about in 1 minute. And that is that the engine, the economy of the United States, particularly in this hemisphere, but globally, has been able to keep markets going, markets
Absolutely.
expanding. And I think that all the pessimists that first were looking at Brazil a few years ago, saying how bad it was going to be. Said the same thing about the United States. And if you don't mind, I'm going to go back to David now, because it's a perfect time to put a good side to this, and that is that the prospects for the United States, everybody was sure it was going to be a recession, but how bad? And David has a contrarian, which is now becoming a more popular vision for the United States. So pause for a minute. David, United States.
All right, thanks, Cliff. Let me show you some slides here. Go back one. So 2 years, or I guess 3 years ago at this point, early 2020, we had, let's say 2 years ago, early 2022, we had very high inflation, a very tight labor market, very high wage growth, and at least some creeping signs that inflation psychology was moving up. And most people concluded, not unfairly, that the only solution to this inflationary overheating problem was a recession. We saw it somewhat differently. When we looked back, kind of historical analogies, I saw this cycle as something of a novelty, sort of a mix of the supply-demand imbalances that fueled inflation after World War II. People wanted to buy cars. We're accustomed to making tanks. Eventually, we'll figure things out, but we don't need to impose a recession. And the inflationary overheating that we had in the late 1960s, when ultimately it did take a recession to solve the problem. Since the beginning of this debate, we on the economics team at Goldman Sachs have argued that you did not need a recession. You did not need to make 5 to 10 million people unemployed in order to solve the inflation problem. There were 3 distinguishing ideas that really informed our framework for a soft landing. The first idea, which I would say was a minority view, but not an uncommon one, was that long after it had become unfashionable to say so, much of the excess inflation and much of the excess wage growth, too, was indeed transitory. Some of it was the product of a war breaking out, but inflation is a rate of change. As long as you don't have 2 wars breaking out the next year, you're not going to get an equal surge in prices. And some of it was a consequence of what I would call shortage effects. People wanted to buy precisely the items that the global economy was struggling to produce temporarily amidst supply chain disruptions. And it turns out that when you run out of things, you get an awful lot more inflation than when the level of aggregate demand is just a little bit too high. But the silver lining is, while we might run out of cars and bid up the price, someday we're going to have enough cars again, and competition will kick back in, push those prices back down. So that was one key idea. And I'd say the novel part of our view on that was that this applied to the wage growth situation as well. Yes, wage growth in the US got to a level much too high to be compatible with 2% inflation. But when you looked into the details, it was clear that most of this was at the lower end of the pay scale. And it seemed to be pretty straightforwardly a consequence of government policies that, for example, paid more for a period of time in unemployment benefits than in wages. The key was these were temporary policies and these were temporary effects. The second key idea in what became our framework for thinking about a soft landing was the idea that while, yes, we did have an imbalance between demand and supply, there was a gentler solution. Sure, you could just crush demand by raising interest rates enough, make millions of people unemployed, but bring the two back into balance. But if you could tighten fiscal and monetary policy just so to keep demand growing, but at a slow pace, supply could gradually catch up. To be sure, this was not a 6 to 12-month solution to the inflation problem. But if you were willing to wait 2 to 3 years, if you were willing to say that's not ideal, but it's better than having a recession, then we thought through an extended period of below potential growth, you could rebalance supply and demand. It sounds like an obvious idea in retrospect, but it was a novel one at the time. The third part, the third kind of key idea in our framework was the thought that while, yes, the labor market was very overheated, in fact, judging by our jobs workers gap, a new measure of labor market tightness we introduced, historically overheated, it was overheated in an unusual way. It was not that the level of employment was high or that unemployment was particularly low. It was that millions of people had withdrawn from the labor force, whether because of COVID or because of the fiscal measures. In any case, it seemed mostly temporary. And it was because the level of job openings had gotten to an extraordinarily high level. And so we thought that restraint imposed on labor demand will take the largely harmless form of a reduction in job openings rather than an increase in unemployment. Now, in 2022, everything went step by step just as it was supposed to go. We did an enormous amount of fiscal and monetary policy tightening. As that first dark blue bar shows you, we got demand growth or GDP growth down to a clearly subdued, below potential pace, and that began to yield dividends in terms of rebalancing supply and demand in the labor market and bringing down at least a tiny bit wage growth and inflation.
David, were the stats last week a validation of exactly what you're saying?
I think so. So that brings us to the story of 2023, which has been a surprising one to just about everyone, in the sense that on January 1st, I would have thought, Fed officials would have thought, the game plan is simply to continue exactly what we began in 2022. Raise interest rates however much it takes to stay on this subdued growth path so that supply and demand continue to rebalance and inflation gradually comes down. The happy paradox of 2023 is that we have gone wildly off track. Growth this year has been at, if not above potential, all year long. We just had a nearly 5% annualized growth rate in the third quarter, and yet everything seems to be working out anyway. Our jobs workers gap has come down even more quickly this year than it did last year, and progress on bringing down wage growth and inflation has been more impressive this year than last year. Not only has progress continued, but I would argue, as the presentation is titled—
David, pause for a minute.
Yeah.
Secretary González, you're getting more satisfied?
No, I've always been satisfied. You didn't let me
More of an
finish, but
optimist?
yes, of course.
You got to live down in Brazil. We're all optimists.
No, I was about to get to the optimist part, but he did the job, so it's nicer. You can believe him more than me.
David, sorry to interrupt.
Not at all. So at this point, I would be inclined to say, not only have we continued to make progress this year, but as the presentation was titled, I saw a few of you chuckling at this, the hard part is over. The two things that you were supposed to be worried about in 2022 that I was worried about as well, just not quite as much as other people, were number one, that it might be tough to rebalance the labor market without overdoing it and pushing us into recession. Well, that problem looks largely solved. On average, measures of labor market tightness are now comparable to where they were in 2019. And number two, the thought that even if a lot of these inflationary shocks were conceptually transitory, there were an awful lot of them. They were very extreme. They were long lasting. And the thought that people might become accustomed to it, that inflation expectations might move up and it might become persistent through that process, that was a reasonable thing to worry about. But now, as we heard Chair Powell say last week, inflation expectations have also come down and look to be in a good place. So are we at 2% inflation yet? Clearly we're not. On a 3 or a 6 month trend basis, we're closer, but still not quite there. But have we created the underlying conditions to get there? I'm inclined to say we're at least 90% of the way there, in that we have rebalanced the labor market, we have normalized inflation psychology. I think the outlook for 2024 will be a lot more normal. I would argue that we are through the worst at this point. The bulk of the tightening in broad financial conditions from the Fed's rate hike cycle actually happened very early. Once the Fed hiked 75 basis points in June, markets got the message that, of course, there's more coming. And what that meant was that financial conditions didn't tighten when the Fed actually delivered the hikes. They tightened well in advance of that. In fact, most of this happened by the first half of 2022, which at this point is a good 5 quarters ago. We use a statistical model to estimate the impact of the tightening in financial conditions, and separately from this, the tightening in fiscal policy on the economy. And in both cases, the message is that we endured a huge amount of tightening in 2022. We got through that. It's diminished in 2023, and it will be pretty modest in 2024. So at this point, I'm inclined to say it was completely fair to worry about recession in 2022. There were some big challenges to navigate. I thought that there was a coherent path to a soft landing, but that's not the same as saying that it was an easy path. But at this point, the things that you were worried about last year don't look threatening anymore. The biggest effects of the hiking cycle seem to be behind us. And so now we have lowered our recession probability for the next 12 months to more or less what you would say in a generic, boring year.
David, could you do me a favor? And can you please text that, all three of those graphs to the governor of the central bank for his next meeting?
Well done.
Great
I
overview.
hope he's right.
We all hope he's right.
We all hope.
So let's take a pause for a minute. And I've asked both the governor and the secretary to think about a question or two they would have of you while you're sitting here. So
Should I go?
either one.
No, I guess the one thing that was not very present on the presentation is the fiscal part of the story, and whether you think there is a fiscal premium embedded in the long end of the curve or not, and what that means, because you can have, you can argue that the debt in the US has been between 40 and 60% of GDP for decades, and then in 2010 it starts going higher and higher. And the projections now are that's going to go higher than 120% of GDP. And part of the reason why the economy is actually strong is because the fiscal spending is being very, very high. So the question is, do you actually, how do you put the fiscal into the equation in terms of the deceleration of the economy going further?
Sure. So I would separate the kind of cyclical fiscal response to the pandemic from the more secular trends that you rightly brought up. On a cyclical basis, the story is we did an enormous amount of stimulus in 2020, did it again in 2021. That delivered a huge boost to growth when the economy was depressed. Most of those measures always had an expiration date built in, and that meant in late 2021 and 2022, you had a very big drag on growth from losing, for example, the stimulus checks, the child tax credit, the enhanced unemployment benefits, and many forms of government spending. Most of that came to an end. This year, we estimate that the fiscal impulse to growth has been modestly negative. The change in the deficit has been quite large, but most of these are sort of accounting things that don't matter a whole lot, or they're things that don't have a very big multiplier effect to the economy. The things that we have taken away this year are the pandemic food stamps and the student loan moratorium. Those are the negatives. The positives would be the CHIPS Act and the Inflation Reduction Act. It's more or less a wash in our analysis. That's going to be true next year as well. A little bit more fiscal drag, but not a lot. What about the secular issues? I think the debt and the path of interest expense are examples of ideas, big developments from last cycle that made an awful lot more sense premised on near zero real rates forever, which is an idea that most people bought into last cycle, than they do in this higher interest rate regime. The argument that many people made last cycle, the story we told ourselves was, sure, we have a debt to GDP ratio that's nearly the highest in history. Sure, we have unusually and probably unsustainably large fiscal deficits that you wouldn't normally have at full employment. But at the very least, because real interest rates on government debt are well below the real growth rate of the economy, the fiscal burden to the taxpayer of servicing that debt doesn't look very burdensome. Look at Japan. Their debt is double ours, same story.
Very interesting.
Now, that looks less true.
Okay. Capitonia.
Yeah, I have a question. I mean, after looking at your predictions, I think to myself, I think we all do. If we had said that the interest rates would be at the level they are today, we had 2 wars going on in the world, and everything else that I don't want to summarize, it's just surprising to me that nothing other than the Silicon Valley Bank, nothing in the emerging markets has broken. And that's just mind-boggling, and we talked a bit about it. And I think part of the answer is that the U.S. never went into a recession. So, you have higher interest rates, but if the U.S. is buying cars from Mexico and stuff from Brazil, you're okay. You can meet your payments. If I follow what you say, which is that, we're going to follow a soft landing, the U.S. is going to keep buying, let's just make this caricature, cars and soybeans or commodities from somebody else, then we should be okay. Is that what you think for the emerging markets as well?
I think that's basically right. Normally, there are large spillover.
That's not what I think, but is that what you think?
Yeah, normally there are large spillover effects from U.S. monetary policy to the rest of the world. I think what was different this cycle was that many emerging market countries were well ahead of the United States in raising interest rates, so that by the time the U.S. got around to it, emerging market economies had already moved through a lot of the consequences of rate hikes.
The former secretary, by the way, is an advisor and a close friend of Valor. And I really feel we're fortunate to have him involved with us. And it's always good to not have a contrarian, but to have different points of view. And it makes a healthy decision at the end.
I am sure.
I'm going to thank all three of you, but I'm going to, with Scott's permission, but he's not here, so that's good, extend for an extra 3 or 4 minutes. Valor is very focused on digital finance, and Brazil is probably the global leader in that, definitely one of them. You sit at the IMF meetings, you sit at all of the meetings with your peers. We don't need to get into the details of the conversations, but why is Brazil the leader, and what are the prospects for the future of further democratization in the financial world in Brazil?
I actually think many countries are advancing a lot on this intersection between technology and finance. In Brazil, we have advanced a lot in the last 4 or 5 years, but I think you see some other countries that are also advancing a lot. And different systems, just different countries have different systems, and they have different levels of difficulties in terms of applying like an integrated plan. But in the case of Brazil, one thing that I can say is that we would never imagine the speed of adoption that we had. Thinking that we created an instant payment system that last week crossed 175 million transactions in a day. It's almost 1 transaction per person per day. We never imagined that. It's much more dense now, for example, than India, that has the system UPI for a long time. So the speed of adoption has been amazing. And also, what has been amazing is the power of democratization that this has, especially in the low-income population. So you have between 7 and 8 million people that open bank accounts just to have Pix, just to be able to do it. People who sell and buy small things that are small tickets, small value, they are now use Pix, and you have generated more than 1 million new business from people that were not able to do this before because they produce things that are very small ticket size, and if to transfer money it costs, you would make the business unviable. So I think probably a lot of countries are doing amazing things. I think Brazil had a more integrated approach, so it was not only instant payment, was instant payment, the open finance on the top of instant payment to get real portability and comparability on real time, and then the digital currency, because our digital currency is kind of different from the other projects in a sense that is a tokenization of a deposit, which inserts the concept of tokenization inside the balance sheet of the banks, and that improves securitization, improves risk management. So I think that brings the efficiency to a different level. So, but I think many different countries are doing wonderful things.
I didn't mean to say other countries weren't, but clearly Brazil is one of the leading countries. Last question, and then I'm going to thank the three of you for what we could be here for another hour. A vision for the future, 1 or 2 things that you see the central bank will be working on into 2024 that will be new, exciting, different. So
first, we had instant payment, which was the trail that we need to have, and people are now in it. Then you put the open finance on the top of it, which means people can share data and can compare products in real time. Then you have the internationalization of the currency, and then you have the digital currency. What I think we will have in the future is you're going to have countries with digital currencies that are connected digitally, and a lot of this debate of which currency will prevail in the future or whether we want to have a common currency, I think that's going to be old debate. Because if you can have digital currencies connected to each other in real time, this becomes meaningless, because the big advantage of this story on common currencies is on trade, on efficiency. And you can do that with technology in a much better way.
I only wish we had another 30 minutes because I bring Dan Schulman up here, who just left as CEO of PayPal, who has obviously a great relationship with the governor. That'd be a great conversation to have. Save it for the next summit. Brian Brooks, one of our advisors, one of our IC members, and part of the family. Brian, closing remarks?
Well, I just have I have a question, and I'm going to admit, Cliff, this is a planted question. Scott heard you say that he wasn't here, so he told me that he was going to get the last word through my question. So I'm Brian Brooks. I know many of you. It's great to see you. And Roberto, thanks so much for being here today. You talk about open finance. Here's the question I have for you. Valor has either made or is looking at 3 or 4 investments of companies whose whole business is not on the payment side, but it's on really the deposit side. And the idea is that there are dollar-based stablecoin savings products in Latin America. So the thinking is in countries like Argentina, Venezuela, other super high inflationary economies, there's a market, forget about payments, but just for savings products. Brazil is less of a hyperinflationary economy, but how do you think about the relevance of fiat currency in the region when suddenly blockchains are making dollar products available in countries where the banking system doesn't support that? Is that a threat to monetary policy in the region? Are dollar products, are they the new euro dollars of the 21st century? How do you think about these businesses?
I think both things can live together. But for example, if you go into many countries in Latin America now, people are using Pix to pay. If you go in Argentina, people are using Pix. If you go in Uruguay, people are using Pix. And the stable currency and the DLT platform is advancing a lot, but it's not connected to banks and to small shops still the way that instant payment is. They can be in the future, and I think those things can live together. And the idea actually is, I see a lot of central banks trying to expel or to distance or to move away from the blockchain space, whether it's crypto or stable coins. And what we're trying to do is the opposite. We're trying to bring it closer to us. And that's why our digital currency is a tokenization of a deposit, because once the bank sees its deposit in a token way, is going to be able to interact with the DeFi space in a much more productive way.
Any way we can get you in a room with Jay Powell to have that conversation? Thanks very much.
Thank you all very much.
Thank you.
We got everything.
Thanks a lot.